Over the weekend, Ethereum survived the single largest liquidation event in crypto history. A staggering liquidation cascade sent ETH plummeting to as low as $3,600. And while it has since clawed its way back above $4,000,
the damage was done.
The event has left many investors asking, is the bull run over for ETH? Are there any catalysts left that could possibly push ETH back to its all-time high, let alone past it? Today, we are going to do a full comprehensive breakdown. We'll cover what caused this historic crash, why Ethereum fell so much more than Bitcoin, and how it managed to recover. Then we'll look forward to the powerful catalysts that could send Ethereum to prices many think are impossible, as well as some hidden risks lurking around the corner. My name is Nick. Don't go anywhere. Firstly, nothing in this video is financial advice. It's educational content intended to inform you about ETH and its future prospects. And if you want more content like this, then smash that like button and let us know your personal Ethereum predictions down below in the comments. Now, let's set the scene. What caused this market-wide meltdown? It wasn't a crypto-native event. There was no protocol hack, no exchange collapses. This was a pure, old-school geopolitical fear. On Friday, 10th of October, President Trump dropped a bombshell announcement, a 100% tariff on all Chinese imports effective 1st of November. Global markets panicked. The S&P 500 had its worst day since April. And because crypto markets never sleep, they took the first and hardest hit. The result? The largest liquidation cascade in history. To put this into perspective, this single event was nearly 20 times larger than the COVID crash of March 2020. Over 1.6 million traders were liquidated, and in the first hour alone, over $7 billion in long positions were vaporized. Ethereum was at the epicenter of this carnage. It plunged from over $4,300, wicking down to the $3,600 range in a brutal 16% intraday drop. But here's the critical question. Why did ETH fall so much harder than Bitcoin? Bitcoin fell by around 8 to 12%, but ETH fell a staggering 16 to 20% depending on the exchange you reference. Well, the answer lies in one word: leverage. The derivatives market for Ethereum was a tinderbox waiting for a spark to set it off, and research from CryptoQuant provides the smoking gun. In the weeks leading up to the crash, Ethereum's estimated leverage ratio had climbed to a high of 0.57. Meanwhile, Bitcoin's was just 0.269. So, ETH traders were running with more than double the relative leverage than that of Bitcoin traders. And this meant that when the price started to fall, the liquidation cascade on ETH was exponentially more violent, as confirmed by the on-chain data. Ethereum saw a record $10 billion in open interest wiped out in 24 hours, nearly double the deleveraging seen in the Bitcoin markets. So, while a macro event lit the fuse, it was the extreme ETH-specific leverage that caused the explosion. So, how on earth did ETH recover so quickly? Well, if the crash was a story of retail leverage getting wiped out, the recovery was a story of institutional big dogs stepping in. On-chain data showed that as the price cratered, Ethereum's Coinbase Premium Index, which tracks US institutional demand, hit its highest level this year. Institutions weren't selling, they were buying aggressively. Look on-chain data revealed that BitMine, one of the largest corporate holders of ETH, scooped up another 128,718 ETH for $480 million during the dip. Their average cost basis? $3,730 per ETH, right at the bottom. This institutional bid provided a crucial floor for the market, absorbing the panic selling and stabilizing the price, allowing it to climb back above the $4,000 range. Which brings us to today. The market has been cleansed of reckless leverage, the tourists have been shaken out, and now the question is, where do we go from here? Are there any real catalysts that can drive the next leg up? Well, the answer is a resounding yes, and they are all centered around institutional adoption. Let's start with the most obvious one, spot Ethereum ETFs. After a dismal September where inflows collapsed by 92% to just $285 million, October has come roaring back. In the first 2 weeks of October alone, US spot Ethereum ETFs have already seen over $621 million of net inflows. That's more than double the entire month of September in just half the time. BlackRock's iShares Ethereum Trust has been leading the charge, now commanding over half of the entire $30 billion ETH ETF market. But as big as this is, it pales in comparison to the next catalyst. And this is the one that could fundamentally change the entire value proposition of holding Ethereum for institutions. I'm talking about staking ETFs. On the 6th of October, Grayscale officially launched the first US-listed spot crypto ETFs that allow for staking. Pending final approval, their Ethereum and Solana funds will be able to stake their entire underlying assets and pass the yield on to shareholders. Let me explain why this is such a big deal. Right now, institutions can already run a basis trade between the spot ETH ETFs and futures contracts for a relatively safe 7% annualized return. That's already pretty attractive. But now, add staking. ETH staking currently offers an additional yield of around 3%. So all of a sudden, a spot Ethereum ETF becomes an asset that can generate 10% unleveraged US dollar denominated yield on top of any price appreciation of ETH itself. For an institution, this is the holy grail. It transforms Ethereum from a purely speculative growth asset into a yield-bearing productive asset, all within a regulated ETF wrapper. BlackRock, Fidelity, and Van Eck have all filed to add staking to their ETFs, with a key SEC decision deadline coming on the 23rd of October. Although this may change if the ongoing US government shutdown isn't resolved by then. Anyway, if approved, this could unleash a tidal wave of institutional capital that has been waiting on the sidelines for a compliant way to earn on-chain yield. And this leads us directly to our third major catalyst, the rise of digital asset treasury companies. We are seeing a new trend of publicly traded companies who aren't just buying ETH as an investment. Their entire business model is to acquire and hold massive amounts of Ethereum on their balance sheets. Think of them as running the strategy playbook, but with ETH instead of BTC. Companies like Bitmine, SharpLink Gaming, and BitDigital are leading the charge. Collectively, corporate treasuries and ETFs now hold over 12.4 million ETH, and that's more than 10% of the entire Ethereum supply. And this is creating a massive structural supply shock. The amount of ETH available on exchanges is at a 9-year low. At the same time, over 29% of all ETH is locked up in staking contracts. So when you have record institutional demand from new ETFs combined with a dwindling available supply, the basic laws of economics tells you what happens next. But what are the top analysts saying? When could ETH actually top? Standard Chartered has been incredibly bullish, recently raising their year-end 2025 price target to over $7,500, and their long-term view is even more aggressive, calling for $25,000 by 2028. Van Eck has a price target of $22,000 by 2030. The consensus is that if these institutional catalysts play out, a new all-time high is not a matter of if, but when, with many looking towards Q1 of 2026 for a potential cycle top. Now, it's crucial that we balance this optimism with a healthy dose of caution. There are significant hidden risks that could derail this entire thesis, and the first is the macro picture. The entire crash was triggered by a renewed US-China trade tension, and there is a critical deadline for a broader trade deal looming on the 10th of November. If these negotiations fail and tariffs are re-escalated, we could see another major risk-off event across all markets. Second, the regulatory risk. The approval of staking ETFs is not guaranteed. The delay or rejection from the SEC around the 23rd of October deadline would be a major blow to the bullish narrative and could trigger a significant sell-off. Third, and this is a big one, is on-chain selling pressure. Right now, there is a record 2.4 million ETH worth over $10 billion waiting in the validator exit queue. This has extended the exit delay to over 41 days. While much of this is likely institutions reshuffling funds or rotating validators, if even a fraction of this $10 billion is sold on the open market, it could create significant downward pressure on the price. So, to wrap this all up, this historic crash was a violent but arguably healthy flush of excessive leverage from the system. It was triggered by a macro shock, not a fundamental flaw in Ethereum itself. The recovery was driven by institutional buyers who saw the dip as a massive opportunity. Looking forward, the bull case for Ethereum is stronger than ever, built on a foundation of institutional-grade products like Spot ETFs, the game-changing potential of staking yields, and a looming supply shock caused by corporate treasuries and massive staking ratios. However, the path forward is littered with risks. Macro uncertainty, key regulatory decisions, and potential on-chain selling pressure could all stand in the way. The key levels to watch are support around $3,700 and a resistance at $4,260. A break above resistance could signal the start of the next major leg up toward all-time highs and beyond. But a failure could mean more consolidation and choppy price action ahead. And now we want to hear from you. After seeing all the evidence, are you bullish or bearish on Ethereum? What's your price target for the end of this cycle? Let me know in the comments down below. Thank you very much for watching, and I'll see you guys again soon. This is Nick, signing off.